regulatory and compliance topics impacting the financial services industry. And talk about hot topics, we have one today. FinCEN just recently announced a game changer for the funds industry. Basically, they are going to subject investment advisors to the Bank Secrecy Act. For all these years, funds have not been required to have formal AML compliance programs, and the government has been trying to close this loophole numerous times for the last 15, 20 years. And now it might actually finally be happening. So we're going to dig into what the new rule is going to require, how it will impact the funds business, and how likely it is that it's actually going to happen this time. And if this isn't exciting enough, I'm really excited that I have two of my friends and colleagues who are experts on this topic joining me today. Alma Angadi, who is a partner in Financial Services Group of Guidehouse and a former regulator herself, and Sean Park, who runs the platform for venture and emerging funds at Citizen Bank. Welcome to both of you. Thank you so much for joining.
Thank you for having us.
Yeah, thanks for having me.
Yeah. So I'm just going to start off by saying, Alma and I have probably talked about this numerous times since I joined Parallel. It was not an issue that was actually on my radar until I joined Parallel. And then I'm like, how is it possible that we're going out to funds, talking to them about the platform that we sell, and they're all saying, I don't have to do that. And I'm like, that can't be right. And sure enough, it turns out it's kind of right and kind of not. But so Alma, I guess where I would start is just, how did this happen? Why were investment advisors traditionally not part of this framework? What have the efforts been to try to get them into this framework? And are there good reasons why they shouldn't be versus, I know you're a believer that they should be, but what are the reasons why maybe they shouldn't be?
So Suzanne, the history is really interesting here because when I was at FinCEN, I wrote the first rules to cover investment advisors and hedge funds in 2002 and 2003. And I think one of the problems then was the definition of who had to register was such that it was pretty limited because you had to have more than 5 clients, and a lot of the funds would have a partnership as one of the clients with hundreds or thousands of investors under it. That definition was changed. So I think that was part of one reason the Treasury didn't finalize that rule. I think there was a misconception that it wasn't necessary because of the rules that already cover advisors and because they're transacting through other financial institutions, banks and broker dealers. And there was kind of a misconception that and I think in the when they withdrew the 2002 through 2003 rules, they actually said that we're not really worried because there's all of this. And remember, if you look at, and apologize for too much, the money laundering focus was originally cash and drugs. When I got to Treasury, it was all drugs. Then suddenly in September 11th, it was terrorism. Now, and this is reflected in the proposed rule, there is a big focus on national security and the kind of criminals that might use investment advisors and hedge funds don't need immediate access to their liquidity like a drug dealer might. Right? They just want to park it someplace and make some money. So I think that progression of focus is another reason why we are where we are now.
Yeah, I think that makes total sense. I think we've also, first of all, it is a long read. The rule proposal itself is 88 pages or something like that. But there are some really interesting examples in there of why they're going in this direction. But the other thing they did is they issued a risk assessment, which, and we'll get into this a little bit when we start to talk about what the rule actually requires for funds to do. But the risk assessment is a really good history of everything that's happened, and also I think assesses a lot of what you've just talked about, Alma, which is sort of this move towards an interest by money launderers to use investment advisor funds as vehicles and where they can park their money and seem to be perfectly fine parking it for long periods of time. So Sean, I know like your business is really supporting venture funds and emerging funds who need a bank and who use citizens to bank. You and I have talked about this several times before. Of like most banks, and certainly the ones that you've worked at, have had at least some expectation or requirement that funds are doing something that replicates an AML compliance program, even though they haven't been regulatorily mandated to do so. So I guess why are you doing that? Like, is there an argument that like what the bank is doing is sufficient and therefore, sorry, my phone is ringing.
Yeah. Well, so just quickly. So my background is really at venture funds, and so working at a number of venture firms over the last 20 years. This is something that I've seen. I think come under more and more scrutiny, and it's something that I think with some of the things that Alma mentioned, these things that have happened over time, Ukraine, Russia, terrorism, things like this beyond just sort of your general money laundering, let's say. And so, we've definitely, we in the venture community for sure come under more scrutiny from regulators over time. Now, I think I won't speak to Citizens Private Bank's policy about this, but I think just generally, banks are regulated just like similar to broker dealers, by FinCEN, BSA, and so we have a set of standards that we adhere to. And I think there's been a little bit of a misunderstanding between banks and venture funds with respect to, or let's say, different types of investment advisor, or what now would be called, investment advisor, ERAs and certain RIAs, exempt reporting advisors and registered investment advisors. What they require, what their policy is versus what a full-on sort of bank or broker-dealer policy would be. I think there's maybe been a little bit of a mismatch there over the years, and I think now we're coming to a point where they're all becoming aligned.
And Suzanne, just to kind of illustrate what Sean said, of this focus of increase on these kinds of entities, there was some SAR analysis in the proposed rule. 15.4% of RIAs and ERAs have been associated with at least one SAR. That's a pretty big number. And the SARs filed on these entities have increased 400% between 2013 and 2021, compared to the overall increase in SARs of 40%. So there's a lot that the banks are seeing and the broker-dealers are seeing, and I think what the government wants is for the funds themselves to look at what's going on in their
And just to be clear,
base.
So SAR is a suspicious activity report, which
banks
which banks are required to file, right? So if they see something in their transaction monitoring that raises a concern, they will file with FinCEN something called a suspicious activity report. And what Alma is saying, and what is in the rule proposal release, is that when you see a suspicious activity, one of the things you have to do is name the individual or business, the clients of your bank or your broker dealer who are engaged in that activity. And so the fact that there's such a significant increase in banks filing SARs against or about funds and these types of financial institutions certainly suggests that there's at least some strong indication that this is an entry point or maybe an exit point for money lenders. And so I agree. I think that's a really compelling statistics that probably were a big reason for why they're pushing now for this expansion.
Yeah, I mean, I think along with the proposed new rule there, there was some data that was put out by FinCEN that suggested that there's just a lot of activity happening, and it's a huge industry to begin with, right? I think there's 125 trillion is what I read in assets, and a large amount of that is also private funds. So, there's going to be, some, you would think that that size of market, there's going to be, some ability for people to try and sneak through. Bad actors.
Absolutely. Yeah, and I think one of the other things that they mentioned in that, I can't remember if this was in the rule proposal or risk assessment or both, was this notion of sort of arbitrage of like these individuals or entities with ill-gotten gains that they're trying to find a place to use to launder. They're really like looking for, where can I find a fund that has some of the gaps, right, that enable me to do this without a ton of scrutiny. And so I think there's a lot of use of shell companies and a lack of due diligence at the funds to really dig into the beneficial ownership of those shell companies. And so I think we're going to start to see a lot more expectation. And the exam program on this is going to be fascinating to sort of see like how funds manage that and how that really change the calculus from their perspective on what their risk is.
Because that's always where the rubber meets the road, right? I mean, like you said, Sean, there are lots of funds that have some semblance of program that they can show their banking partners or, or their board of directors, but how risk focused is it? How well implemented is it? How sustainable is it? That's hard to say if an outside party isn't looking, if a regulator isn't looking at it.
I mean, my sense is that, if you're an RIA of a certain size, anti-money laundering policy and process procedure has been par for the course for many years now, as long as I can remember. But for these new categories of investment advisor, I suppose the ERAs and the smaller RIAs that are exempt as well, they haven't had to have these programs necessarily, in place. And so, how are they going to do this? They run lean shops generally. They don't generally have a CCO, certainly not usually someone identified as an AML officer. So this is going to be, I think, as you say, Alma, where the rubber hits the road. I think there's going to be a lot of learning. There has been, I think, a fair amount of learning, at least in my experience, from funds since the sort of, for a while now, but certainly since the outset of the Russian war in Ukraine. So, with that and all the, the additional sort of bad actors that are put up on the OFAC and SDN lists, people I think are very aware of it. So, but I do think, with the sort of, if the proposal goes through and there's a formal inclusion of these previously sort of exempt groups, those are going to be the ones that it's going to be interesting to see how they deal with this. I know there's a lot of folks like Parallel Markets waiting to help us out. But I think there's going to be learning curve as well that has to happen there. So it'll be interesting to see, how this gets implemented and the overall cost to the industry.
Because they've been looking at risk in a different way, Sean. They've been looking at credit risk. They've been looking at their regulatory risk as the kind of investor that they're permitted to invest in their fund. They're not looking at where did the money come from. I mean, they may be superficially, they're not going to, knowingly maybe take money from the head of a cartel, but they may not dig too deep, Suzanne, to your point, into those shell companies registered in Las Vegas or Delaware, about who owns them and who controls them and who's just a nominee and where did the money come from, prior investments or whatever they say on the forms.
Yeah, exactly. So I think this is a great segue actually to dig in just a little bit into what it actually means to have an AML compliance program under the Bankruptcy Act. So where I want to start just briefly, because I think we've pretty much touched on it, but just to make sure it's clear to everyone, is first of all, like who's in and who's out, right? And so my understanding is that the proposed rule is going to cover certainly registered investment advisors, and also what are referred to as exempt registered advisors, which typically are venture funds. There's a couple of other categories of exemption. Most of it really has to do with the level of assets that you have under management. So I think the threshold is 100 million. Am I remembering that
100
right?
million to register, right? 100 million to register.
Right. And so, so this is going to cover the vast majority of venture funds, hedge funds, private equity funds, probably even a lot of the family offices. So I think we'll see like a pretty significant expansion in terms of who has an obligation to comply and implement like a formal AML compliance program. So what is a formal AML compliance program? I'll start with Alma. Like I think there's just like some obvious ones like policies and procedures and training. But let's talk for a minute about what it is to have like a dedicated AML officer. Like what does that look like? Can you outsource that? Like how should a fund think about doing that? To Sean's point, if they don't have a person in-house who really has the sort of the expertise and the knowledge to do that.
So I think the first place to start with this program is it has to be risk-based, right? So you're not always going to be able to tell the business when they ask you, where is the rule that says I have to do that, right? Because it's principles-based regulation. So that because of that, I think the CCO has to be, and there's guidance about this, they have to be knowledgeable. So you can't just pick somebody off the street and say, or somebody who might have been doing other kinds of regulatory compliance work and just say, hey, you're the AML compliance officer now. They have to have sufficient resources, both human capital and technology, to do their job, and they have to have authority. So, I mean, Suzanne, you and I used to see this all the time in our old life. They'd pick some 22-year-old. I saw someone once who had been a hairdresser, no training, not going to push back on the business, just going to say, yes, sir, yes, ma'am. So you have to, it doesn't mean they have to be old, but it just means they have to know what they're doing. They have to be given the authority to do their job, and they have to have the resources they need.
And what about outsourcing? Do we think we'll see a lot of funds call Alma and say, hey, can you be my AML officer for my fund?
I think that's fine. But again, there are going to have to be a couple of things going on. You can outsource that, but you're going to have some supervision within the entity of that outsourced person to make sure they're actually doing their job, just like you do an outsourced FinOp or anything else. So I think some funds administrators are already the outsourced compliance for some funds where it's permissible. So I think it's a model that works pretty well. But again, you can't just set it and forget it. The fund management is going to have to make sure there's some oversight and supervision so that they're doing the job they tell you they're doing.
Yeah. All right. So let's move on to another one of the requirements under an AML compliance program, which is the independent auditor. So do we expect that funds are going to have to outsource that and hire like somebody truly independent from outside, or is there a world in which you can characterize somebody or designate somebody as independent from internal?
The rule's very specific in saying it can be internal or external, but they have to be as independent from the program. So if you have an internal audit group, like a lot of big institutions do, they are perfectly capable of doing the independent test of the AML compliance program. What you can't have is the AML compliance officer, somebody who reports to him or her, or somebody that designed or implemented the program. You can do that. That can be a compliance testing, like another control to put in place, but it doesn't count as that independent test.
Yeah. And Sean, is there a world where you could imagine like the bank perform some type of independent audit on behalf of all of these funds? And really citizens, but like, or would you really?
Nothing that I'm aware of, but you know, I was thinking this earlier when we were talking, but I think there is going to be, you know, a world where some form of service provider to the industry, such as like fund admin, those folks, the people that help with onboarding, subscription agreements. There's a lot of those folks out there now. I think, you know, there's definitely a world where, you know, outsourced vendors, service providers will latch onto it and start providing that type of, you know, cover. Because, you know, ultimately, I mean, for speaking, you know, working at a bank, I mean, you know, if our clients fail the test, you know, we need to make sure, you know, that we uncover that as well. So I think there's going to be there's going to be, at least certainly in the beginning, until this all is figured out, there's going to have to be a lot of redundancy, because you do wonder, you know, am I going to be responsible, you know, or will a bank be responsible for your funds policy? And is that policy, you know, their policy and procedures, are they going to be, you know, they're going to be able to outsource that to someone else, an external CCO, and if their policy or procedures, you know, aren't robust enough, are they responsible? I think everybody's going to be responsible ultimately. So I think there's probably going to be a lot of redundancy there. But and yeah, it is interesting because the whole risk-based approach, you know, I sort of chuckle because to me it's difficult to sort of really nail down what that is. When you ask someone, you know, there's a few things, yeah, you know, they're offshore or there's all these strange transactions going on, but ultimately my understanding is, even if you implement a risk-based approach, if you fail, it's your fault still. So you that's where I'm like, okay.
It's so it's interesting on the risk-based approach thing, you know, and thankfully for me, I'm no longer in the business of advising firms on their compliance obligations, but what I would have done if I was sitting in one of these like AML officer or CCO seats now, I think what I would be saying is, they've given you the risk assessment, right? Like if you don't, you pretty much have to create a document that tracks each of the risks that they've identified and say, yep, that is a risk for us, or it is not. And then be able to demonstrate how you sort of tailored your framework around the risks that are identified in that risk assessment that are applicable for you. Now, you may have other ones that aren't mentioned in there, so I'm not sure that's the entire risk assessment that you have to perform, but it gives you a really good roadmap to start with. And I have to imagine that the examiners are going to ask you, like, can you demonstrate that you read it, right? And that you considered like all the risks that we've already identified for you. So that is certainly, I think, where I would start as I'm trying to figure out like what my AML framework is going to look like. So when I think about AML, right, I think about sort of all of these, I don't want to say tangential, but they're almost like the administrative elements: policies, procedures, training, audit.
The 5 pillars.
Right, exactly. But then there's the real substance, right? And substance really boils down, I think, to KYC and transaction monitoring. And then there is some like record keeping and reporting obligations that go along with, especially with the transaction monitoring. So I guess the question is, for the types of funds like a venture fund, where you're making an investment and then it sits for usually a very long time.
Yeah.
Like is that an area where like the venture funds will be able to say, you know, I've done my risk assessment and I don't really have a transaction monitoring requirement because the only transaction I get is an investment and then at some point an exit. Is that a fair way to think of this, or do you think that that's too simplistic?
No, I think you can't say, you're not going to have the same kind of transaction monitoring that a bank or a broker dealer does who has lots of transactions. But I think they will be tasked with looking at that entry and exit transaction and say, does that make sense with what I know about this customer? Say you've got, a Canadian investor, and suddenly they want their money to go to Nairobi. I mean, maybe that's okay, but you might need to, maybe they're investing in a business there, so maybe that's fine. Or Turkey next you want to know, does this make sense for that investor? So I think for these funds, the big point is going to be the KYC, the due diligence, who are these people, where did they get their money, but also looking at where the payments coming from, the investments coming from, and where it's going, just to make sure it makes sense.
So source of funds and source of wealth, you think is still
critical.
Yeah. Okay. And we could do a whole session on just how one goes about that.
Yeah.
But suffice it to say, like if you're getting a wire transfer from your new LP, limited partner, into a venture fund from Bank of America, you probably don't have much more work to do. But if it's coming from like some bank in Africa that you've never heard of before, you probably have some obligation to dig in a little more deeply to understand, like, are they subject to any type of AML protocol? Like how confident can I be that that somebody else has looked at this? And then that's where you might also have to dig into source of wealth to just understand like where is this money coming from, and how does this person have that money to begin with?
So, Suzanne, we were doing some due diligence on a very large investment that was probably higher risk than any institution you or I, have dealt with. But so one of the things we would look at was the investment for that limited partnership coming from another limited partnership, which often happened, right? And sometimes it made sense. It was same beneficial ownership, just a different, they were creating a new fund that wanted to invest in this product. So, but maybe it isn't. Maybe they can't show you that. And maybe sometimes we'd see sanctioned individuals in the third level limited partnership that was, transferring money into what they wanted to be into this investment. So, again, you have to look at all the circumstances. And you're right. If you're getting it from a same name limited partnership from Bank of America, you probably don't have to ask very many more questions. If it's a different limited partnership, even if it's from Bank of America, you might want to ask.
Yeah. Okay. So in the interest of time, I'm like I said, I think there's a lot we could do with that.
We could talk about this all day, sadly.
Yeah. One of the other things that's specifically called out in the rule proposal is the travel rule and like CTR, filing transmittal of funds. So I just wanted to touch on that briefly. First of all, what is the travel rule, and like how should funds think about what they have to do there? And again, I think for the most part, it's a pretty limited thing, because especially for venture funds, the transactions are quite limited. And so the number of times you actually have to do this is pretty small, I think.
No, that's right. And they'll be going through banks in all probability, or other regulated financial institutions. So they will be required to provide the information. But what the travel rule is, it's a record keeping requirement that says there's certain information that you have to obtain when you're transferring money for someone, funds, and that information has to travel with the funds. And the purpose of that is, if I am sending money to you, Suzanne, and you live in Spain, and and the Spanish law enforcement folks want to know how that money got into your account, that information will be at your bank because of the travel rule. So they don't have to go through all of the contortions of cross-border information requests and subpoenas to figure out who sent that money to Suzanne. That information will be there. And you're right, because, and it won't be the entire KYC document. It just has to be XYZ LLP transferred $10 million to their account in the UK, or whatever it is, so that UK bank knows where it came from. So that shouldn't be too big a lift. And I would guess that their financial institution partners, Sean, you know that as well as I, probably better, they're going to ask them for that information anyway, because it's their obligation to send it forward through too.
I'm sure we will. The mechanism for it, I'm not familiar with that.
Yeah. So one of the things that's super interesting and really stuck out to me is FinCEN issued this whole rule proposal. They said, you've got to comply with the BSA framework, and then they essentially excluded or cut out two what I think of as central elements of that framework. Sorry, am I still here?
I see you.
Yeah,
Okay.
we see you. We hear you.
Your spotlight.
Weird. The screen just totally changed, and now I only see myself. So I'm like, hold on, what just happened? Okay, so essentially what they've done is they've said CIP, which is Customer Identification Program, which is really the collection of identity documentation, right? So name, address, date of birth, and typically people collect some type of government issued ID, social security number or tax ID number. And FinCEN is saying you don't have to do that. And the explanation that they gave for why they're not requiring funds to do that right now is because that it will be the subject of a separate rule that is coming out in conjunction with the SEC. So that's one element. And then the other one is beneficial ownership, where under the customer due diligence rule, you're required to collect as any financial institution who is subject to BSA requirements is required to collect beneficial ownership information to the point that we were talking about earlier. So if you're onboarding a legal entity, you have to know who actually owns and controls that entity, including ultimate beneficial ownership, right? So if it goes through several layers of ownership before you get to a natural person, then you've got to sort of take it all the way up to the natural person that has ownership interests in that entity. And they've carved that out as well. Presumably, I think because the CDD rule is going to be rewritten. This is one of the components of the CDD rule in order to track more closely or align with the Corporate Transparency Act. This all starts to sound very complicated, but I guess the real question I have is how to think about what this means. Like, so do I not have to do sort of what are really considered as fundamental KYC elements of collecting ID information and beneficial ownership information, or even without those explicit requirements in the rule, like how does one implement an AML program without those?
Well, Suzanne, that is exactly why they can wait and do it all at once with the amendments to the Corporate Transparency Act and a new rule. This goes back to the risk-based program. If you have to understand the risk of your clients, how can you possibly do that without knowing who they are, who owns them, and who controls them? What the CDD rule is, and if the customer due diligence rule, they actually said in the rule that everything in this rule has been a regulatory expectation since the beginning. All that's different is we're saying you have to get beneficial ownership at 25%. And oh, by the way, if it's a high risk client, you might want to get it at a lower rate, a lower percentage than that. So I think that the funds should just use the current rules as a guide, and because they're not going to change much when they bring them in, I would be shocked. And just look at it as, look, we have to understand who our customers are really and who owns and controls them, notwithstanding whether there is a specific rule telling us exactly how to do that.
Yeah, I think that's right. I mean, it's like sort of fascinating to me how you would implement an AML program without some level of that. And so I don't know if either of you have any like inside tracker or intel on like when the CDD rule and this new, joint SEC FinCEN CIP rule are going to come into effect. But it's very interesting to me that I mean, it makes sense to me that they carved them out. And at the same time, it's like, I'm not sure how a fund should think about building their AML program without knowing what those elements of the rule requirements are going to be.
I think I agree with Alma. I think you have to go with what we know for now and just continue the same program as if it were in effect. And I'm with you. I'm like, I am wondering. I saw that the comment period was, up until April 15th, I believe. But I am curious. I haven't seen anything from like the NVCA yet, or any lobbying groups, and they've been fairly successful over the last 20 years, to my knowledge. So I am curious when we're going to hear from the industry, or do we just assume, that it's gonna become law?
Yeah, so that's actually the very next area that I wanted to go into with the couple of minutes that we have left, which is, on a scale of 1 to 10, how confident are we that this rule is actually going to go into effect? And then one of the questions that's certainly on my mind is, is there a ticking clock here? Is there a risk that if this rule isn't finalized by November and we get a Republican administration in place, which who the heck knows if that's going to happen, and there's all kinds of other risks. But do we think that this will get tabled again? And does it matter if it's a Republican or a Democrat victory in November? And what do we think the timing is? Just curious to get your thoughts on that.
I think it's about an 8 because of the national security concerns, because people are taking this very seriously. Russian and Chinese investments in technology companies and in the US that can escape the other regulations that deal with foreign investment in the US. And the last time this rule was scheduled to be finalized, I believe the Trump administration stopped it. So I think the Republicans are, I don't know if they're more friendly to hedge funds or businesses or whatever, but I don't think in the past, they have not seen the need for this in this part of the financial services ecosystem. So I think it's a risk.
Yeah, I don't have a number for you. I think, whether it happens now or later, I suspect, given the direction we've been going in over the last 20 years, and Republican and Democrat administrations, to my knowledge, have been trying to implement it. I think it's going to happen at some point, and sort of logically, if you have, this program, the AML program, but you have some areas where there's some, call it leakage, you want to plug those leaks. And I think logically that makes sense. But as far as the timing, who knows? I don't know if, I just don't know. I don't have any sense of the timing in terms of, if you get comments back by April, what then is the sort of the legal timeline before it can be approved and implemented? Is it an overnight thing? Is it another year? I have no idea. So, I don't know if we get caught up in the election, if that's going to, postpone anything or not. But over time, I think it has to happen.
And Suzanne, there's kind of an analogous situation that led to the beneficial ownership rule. Most other countries under the Financial Action Task Force recommendations were collecting beneficial ownership at 25%. And again, for 20 years, the US said, we don't need a rule. We have a risk-based program we enforce. People are doing it. Then two things happened. You had the Panama Papers and the Paradise Papers showing that these people had no idea who owned large swaths of their business, of their customers. And secondly, you had the potential of the Financial Action Task Force evaluates every country who's a member, and they were, I think, threatening to sort of criticize the US for not having that rule. So that may well be something else that's influencing this. Is at our next mutual evaluation, can we escape getting called out for not having a rule that most other jurisdictions have? And again, with the information that we're seeing of national security implications, those two factors, I think, might push this over the edge this time. But I'm guessing.
Yeah, I mean, that's sort of my sense too, is it really feels like the time for this has come, and it's sort of time to close this I'm calling this session closing the loophole. I don't know if it's a loophole or a gap, but one way or the other, it does definitely feel like it's time for funds to take some responsibility for protecting the financial markets, especially. I think the number I saw was like, what was it, $125 trillion of assets, right? So this is not
a lot of money.
It's a lot of money.
Yeah.
So I know we're at time. My very last question is just, given the comment period ends in April, then I think what we've heard is it'll be a year from when the rule is finalized until you actually have to comply. Should funds just wait? Or is there anything you think they should already be doing to start to get ready for this?
My sense is, definitely get educated on what the issues are, and understand what the 5 pillars are, for example, and what would be required of you. And I think there's a lot of education that needs to happen. My sense would be, you don't want to be a trailblazer, but you want to be a fast follower in this kind of thing. But in order to do that, I think you need to be educated now, because it does look, if you think it's likely that it becomes law, then you're going to need to implement these policies, and you have to be ahead of this stuff, I think, because I think it's going to be material change, certainly for these, ERAs and the RAs that previously haven't been covered. So, there's going to be, I'm sure there's going to be a lot of scrambling anyway, but I think folks are going to have to really give it some thought in terms of, how can we implement these things, given, as I mentioned earlier, many of these funds and firms are a lot smaller and run leaner. They may have a couple of investors, general partners, say, but then a lot of the supporting staff may already be fractional or outsourced. So I think there's a lot of education that has to happen, and given the timeline, that will go by really quickly if it does get adopted. So I wouldn't want to wait to the last minute, that's for sure.
And Suzanne, I'd just add one final thing to Sean's very good advice. You shouldn't need a rule for good risk management. And a lot of these practices are just good risk management. Who are you doing business with, really? And what would happen if who owns those LLCs shows up on the front page of the New York Times tomorrow? What does that look like?
100%.
So I think you should be doing it anyway to some limited extent. Again, not all the bells and whistles and tick and tying to the rules, but it's good risk management.
Yeah, I think that's exactly right. Probably the subject of another one of these sessions is actually going to be the Binance case, and I think one of the things that's super interesting about that, but not obviously they got fined a huge amount of money. The CEO is out, like a lot of ramifications, but they just got sued by the families of victims of the Hamas attack in Israel. Because they were facilitating the financing of that attack. And so, the reputational aspects of this and just the moral and ethical, ramifications are huge. And so, I think it's great to sort of force funds' hands, but I also think the most responsible ones are already trying to do some of this, and hopefully this will just give them further frameworks and guardrails to operate within. So I cannot thank you both enough. I really appreciate your joining me on this. And I'm sure we might reconvene again once the rule is actually announced, and kind of see how close we were in our predictions to.
Oh, that'd be fun.
Actually.